Yo, what's up everybody? It is Wednesday, February 23rd, another big down day in the market. Looks like we're going to test the January 24th low in the S&P. I got my eye on that, and I think we could take out that low, you know, a marginal new low in the, I think that was 42.12 in the March S&P futures. I think we'll see the market trade below that, but I suspect that we'll see a bottom there and a bounce from there. So far, and by the way, I don't think this sell-off, particularly today, the market seems to be, for me, trading on an outlook that now is not really related to the Ukraine situation. I understand that the Ukraine situation has been a catalyst for much of this sell-off, I would say, for the last few weeks. But today's price action, to me, I don't know, there wasn't a lot of Ukraine news. I know Biden, he sanctioned Nord Stream 2, but I mean, the Germans canceled that yesterday. They canceled certification of Nord Stream, so that wasn't going to happen anyway. I think that's my opinion, that I don't think the market, whatever's bothering the market, I do not think today's action reflected an escalation in the Ukraine situation. I think Ukraine, to evolve to the next step, to escalate to the next step, you know, I think that's going to take a little bit of time. Right now, we know what's happening. Russian military has moved into the Donbass region. There was reports of Russian tanks or whatever. They're going in there ostensibly as peacekeepers. And I'm not going to get into the war situation or the, you know, whatever you want to call it, this Russia, US, NATO situation, Ukraine. I'm just going to focus on the economics here in this video, all right? So we saw yesterday a 15 billion IRS tax refund flow. That was the first significant IRS tax refund you know, so far this month of February. Now, there have been reports that I've been reading about a backlog in the IRS. They're behind by millions of filings, and, you know, the refunds are being delayed. February, historically, the month of February is the biggest month for IRS tax refunds. It could be well in excess of 100 billion for the month. Right now we're at about 37 billion, 38 billion, something like that. So it's way behind. And that is what is keeping, actually, February's flow right now, we're running at about a 29.6 billion. I believe it's a 29, it might be 29 even, maybe I got to check that. 29 billion 10-day average of the daily flows. That comes to about, I think, around a 580 or 585 billion monthly flow. That's decent. That's solid. 580 billion. And again, we're behind on the IRS tax refunds. If they get up to speed, then, you know, we'll be well over 600 billion for the month. So this is a good month. Now, March is not going to come in as February has come in, because, again, February we had the quarterly interest payment and these IRS tax refunds. But there will be IRS tax refunds in March as well. It's just, it starts to scale down after March. You have March is the big month. I'm sorry, February is the big month. March is less. By the time you get to April anyway is tax filing season. That's when, you know, we got to send the checks in. That's how come you've probably heard the old Wall Street adage, sell in May and go away, because everybody's broke by the end of April because we got to pay our taxes. Terrible. Terrible. I hate it. But right now, look, I think this is part of a correction which is reflecting a slowdown in the economy's growth rate from the fourth quarter of last year. The fourth quarter of last year, we were growing at 7%. I mean, now, anyway, the Atlanta Fed is forecasting a 1.3% growth rate for Q1 2022. It could be a little bit higher. I would say probably looking more like around a 2%, maybe slightly higher, 2.2% growth rate. So that is a pretty significant deceleration, okay, from the fourth quarter of last year. But we know why. I mean, they cut the child tax credit payments. Unemployment fizzled out in, well, it was before the fourth quarter. That ended in September. So that ended at the end of the third quarter. And that had a material effect. And those child tax credit payments, I mean, they were significant. They were significant. So we are seeing the fiscal flows drop down from what we saw in the fourth quarter. But again, 580 billion, 600 billion. I mean, that is not a number, that is not a flow which tells us that the economy is going to crater. I mean, that you're still talking about, what, 25%, 30%, maybe even 40% above where we were in the pre-pandemic period when we were running about, 420, 430 billion a month. So it's still significant. So I think we'll get a double bottom here, like maybe a marginal new low in the S&P. I'm looking for that 4212 level in the March S&P futures to be taken out. And then I think we'll see a rebound. One thing I've noticed, and we're going to get the sentiment numbers tonight in the AAII weekly sentiment survey. So that's probably going to be really, really negative. I mean, last week we saw bullish sentiment at the lowest level in 6 years. I'm very interested to see what the AAII says tonight. The other thing I saw was in the last week. That is, what was yesterday? Tuesday was the 22nd. So from February 15th to the 22nd, we saw a 100,000 contract build in S&P E-mini open interest. So 100,000 contract build. Money was coming into the market basically on the decline. And that was the first time we saw a sizable build of that magnitude. It brought open interest in the S&P E-minis up to the highest level in 2 months. Now, in order for open interest to increase, I mean, if you understand open interest, you need to have a new long and a new short. So there was money coming in big time in the recent week on the downside, but that means there was new shorts and there were new longs. So there was fresh buying and there was fresh selling. All right? And we went for a pretty significant period of time where we saw open interest declining. In other words, money was getting out of the market. It was getting out of the market. It was leaving. I think that set up an environment where, we got this sell-off because, again, you had all the news about Ukraine and fears about the Fed. I think, here's something that I think could possibly play out this way. Is we have the Fed meeting on March 16th. There's going to be a rate hike there. This has been building up and building up and building up for a really long time. And initially, Fed fund futures were pricing in a 50 basis point rate hike. Now it's leaning more towards a 25 basis point rate hike. We'll see what happens. But I think once we get that rate hike, which has been so built up and so anticipated, and everybody, frightened and worried about Fed, shifting its policy stance, I think once we get that rate hike, we could see the market start to rally again, because that's been priced in. And it's been priced in pretty much with the 10-year at 2%. And if you go out, if you look at that Fed fund, the CME has a thing called the Fed Watch tool, the Fed Watch tool. You could go online and Google that and check it out. And it gives you the probabilities for every single Fed meeting going out to, I believe it's going out to July 2023, if I'm not mistaken. And you see what the market is pricing in terms of rate hikes. And basically, you know, we're looking at rates going up to 2%, which, by the way, the 10-year, that's where we are, at 2%. And then it stops. So I think a lot of that is already priced in. So I wouldn't be surprised if we see that rate hike on March 16th. It's only a couple of weeks away, like 3 weeks away, maybe a little bit less. And, you know, that would signify a bottom in the market. Because, again, we have very decent fiscal. The fiscal is very good. It's solid. It's not the kind of fiscal environment that I think would suggest a really weak economy, or certainly not a recession. So you got to go with the correction scenario. I think you got to go with the correction scenario. The stock market correction is just reflecting a slowdown in the economy from the fourth quarter of last year, 7% growth, to now maybe 2% growth. 2% growth, by the way, has between 2 and 3% growth of this U.S. economy has kind of been the average over the last, 20 years. So, I mean, we're just getting back to our baseline average of what we normally, historically, have seen over the last, 2 decades. And the stock market has done very, very well. Now, we had shocks along the way, and certainly this war was, this is an emotional thing. Headline risk everywhere. We didn't know where it would lead. The build up to, Russia's declaration of the Donbass region as independent. We saw it happen. Now they're in there as peacekeepers ostensibly. Hopefully the thing just stays kind of at a stalemate where it is right now. But again, I'm focused on the economics. The fiscal looks strong. Let's see what happens. 42.12 in the March S&P futures. You take that out marginally, a new low, and then I think you get in there and you buy. The other scenario is that you wait until the March 16th Fed rate hike, and that will be the bottom. All right, everybody, that's it for today. I hope you had a good day. See you tomorrow. Bye.